Welcome to Wealth Matters Podcast. I have Kris Benson with me. He's the Chief Investment Officer for Reliant Investments, a subsidiary of Reliant Real Estate Management, and one of the top 25 commercial self-storage operators in the US in 2019. Kriss is part of the investment committee at Reliant, and he helps in developing institutional quality self-storage investment opportunities for accredited investors, and that's why he's here. Personally, my investments, I'm moving into more into mobile home park space and self-storage space. I feel like they are the most resilient. And after COVID, even though most of the real estate is going up, but I'm looking forward to, investing in this asset type. So welcome, Kriss.
Thank you, Alvish. Appreciate the opportunity.
Absolutely. So Kriss, I hope I covered everything. If I did not, feel free to add.
Sure. Yeah, I think that's a good introduction. And I agree with you. Mobile home parks as well as self-storage, I think it fared pretty well through at least COVID. We're recording this at the beginning of October, so
yes,
far so good. We're certainly not out of the woods yet. We may want to in a few months from now and make sure we're still in that case.
Yep. So tell us something interesting about yourself.
I got all kinds of interesting stuff. I'm a big motorhead, Alvish. I love toys with engines in them.
Wow.
And I have to tell you that although I believe, what Elon Musk is doing is certainly the future, it's unquestionable and inevitable. Yeah. It ruins my life because for me, internal combustion engines are one of my favorite things in the world. I'm going to tell you just a quick, interesting story and then we'll get moving on. I know you want to talk about real estate, but the sounds that motors make are incredible, especially depending on what type you're thinking of, right? But if you think of like Formula One cars or drag cars or even boats, there's some incredible exhaust that come from that. And the biggest issue for me with Tesla is the sound. There's nothing.
I have a Tesla.
They've done it with motorcycles, right? And I get it. The technology's vastly superior, but there's no sound. So my son recommended that Elon Musk, if he's listening to your podcast, starts to insert an option where you can choose the sound your car makes while you're driving around. So if you want your Model S to sound like a Formula One car, you just push the button.
Yeah, no, that's a great option. And I think so I have a Model 3, right?
Okay.
We barely drive car actually. I work from home. I don't go most, but I love the car, but that was one of the complaint, not my complaint, but that, it didn't make any noise. And it never warned pedestrians and cyclists, right? Because there was no noise when you're walking around. So the new, they always update the software. The new software now you can choose some noise, right? But it's of course not Formula One.
Oh, can you really? You can choose an exhaust note?
Yeah, not the exhaust note, but it allows you to turn on and off a noise, right? So that, I prefer noise so that I can at least warn someone. But it does not give you option to select, the kind of exhaust note you would want.
And what does the noise sound like? I'm gonna have to YouTube this.
It's weird. It just makes like regular cars, but someone can at least understand something is coming, right? Something is passing by instead of no noise, right? It was so quiet that now at least there is some noise. But
I'll let my son know.
Yeah, it's not similar, but I know what you mean because growing up, I was fascinated by motorcycles. And when they started making motorcycles with, pretty much no noise, or they started reducing the noise, I hated that. So we used to make holes in the exhaust pipe so that it will make larger noise. So I can relate to that.
For sure. So, but anyways, that's my interesting fact of the day.
No, that's interesting for sure. Why did you choose to be in real estate?
Not too dissimilar than what most people, the path most people choose to go on. I distinctly remember, and I've said it in a few other podcasts I've been on, there was a moment when I was just before I turned 30 where I woke up and said, I can't do this anymore, right? I was in a corporate sales job, which was incredible. I've been very fortunate in my career to be a part of some really good companies with incredible technology. And but what used to eat at me, Alpish, was I remember like late Friday nights, and you'd be in an airport somewhere, see that guy or gal who's in their 60s still carrying a bag, and I was like, that is not going to be me. I'm not doing that. And I was making great money and all of that, but I guess in the traditional definitions of success, I was doing really well. But it was the conversation with yourself that you have where you don't want to trade time for freedom. And I'm not the creative type where I'm going to create something. I'm more of an expert, and real estate is pretty black and white, right? It's number. It makes sense to me. So that was the path. That was the path that I chose to start to create some passive income.
So that's a great point you mentioned, right? So even personally, I read a lot of self-help books and personal development, and every time I keep asking myself, what does success mean? Is it money? Is it time? And I'm always, talking to people, and when I tell them, oh yeah, you're making 400 grand, 500 grand at Netflix or Google, how much time do you have, right? They're like, oh yeah, but I got money, right? So it's an interesting topic, right? And everyone has that definition of success somewhat different, right? What do you mean by success, right?
Have you ever read the Fisherman's Parable, or I think it's called Enough?
No, I have not. I should read that.
All right, I'll send you the link to it. Basically, just high level for your listeners, it's a story about a fisherman who's really successful, and he goes out and fishes in the morning, and then he comes home and catches a ton of fish, comes home, takes a nap, hangs out with his family, eats and drinks at night, has a great time. And a businessman comes along and sees how successful he is at catching fish and says, why don't you fish all day? Like, you could crush it, make a whole lot of money, and then retire with a lot of money. And the guy was like, well, what would I do when I was retired? And he said, well, you could take naps, hang out with your family, and eat and drink and have a great time. He's like, well, that's what I do. So, I'm paraphrasing, and I'm not doing it justice at all. It is probably not Fisherman's Parable, but I'll send you the link. You can put it in the show notes.
Oh, for sure. Yeah, I love reading, so definitely. So, but how did you end up in real estate? So at that point, when you realized that the corporate job is not for you, what path did you take?
So probably similar to what a lot of your listeners are doing as well. We started out in duplexes in the town that we're in. And the originally was, if I could make basically $200 a door, right?
Right.
So how I was underwriting is I didn't really know anything else other than that's what I was doing. And my underwriting was far from accurate at the time. So that's what we started doing. And it was okay. We scaled it to some extent at about 20, we had 22 units. And at about that time, I realized that I hated it. And it wasn't really the real estate or, the maintenance issues. We had that pretty well taken care of. The challenge was the people part of it.
Right.
We had class B minus kind of stuff, maybe C plus, and the people issues were soul sucking. It didn't make sense, and I didn't want to scale and continue more of that. So we ended up selling the portfolio, and so we made a little bit of money. And at that point, I'd heard a podcast or read it, and I wish I could give credit to who I took it from, but ostensibly it was the quote that big deals and small deals are the same amount of work. You just money on small deals. And so I wanted to get commercial multifamily. And interestingly, made a cold call to a guy that I used to go to church with when I was a kid. Hadn't talked to him in probably 15 years, and said, hey, I got a little bit of money. I want to build some apartments. What do you got? And interestingly, he had just had a meeting with the municipality and on a piece of land that they wanted to develop. We got it for dirt cheap and built 64 units. And so that was the beginning of my commercial real estate journey, and a huge learning experience for me.
That's awesome. So then how and when did you move into self-storage?
Yeah, so about 4 or 5 years ago, multifamily, as you know, cap rates have continued to compress, right?
And everyone wants to do it, right? That was my problem, sorry to interrupt, but whenever I attended all those conferences, every mom and pop wants to get into multifamily. So the cap rates are compressing. The competition is way high.
At all levels too, Alvish, right? We're not just talking about the big 200 plus units.
Yes.
The 40 to 50 unit, like everybody.
Yeah. Oh, yes. Even a fourplex.
It's been a great asset class.
Even a fourplex, right? You try to get it, and there are like 15, 20 offers. It's just...
The secret is out. So, I think for me, it was seeing that and saying, okay, perhaps there's some other asset classes that have some runway and maybe some more value in. And so I'm a data guy. I like to look at data and kind of make my decisions, hopefully based on data most of the time. And I also like the National Association of REIT data, NAREIT. And the reason it's good is you can basically track any real estate investment trust across any asset class for as long as it's been recorded. So if there's a REIT doing that particular business, the NAREIT records it. So, and with self-storage, they have a 25-year track record. So you can go back and see how the REITs have done. And, the average annual return on the self-storage REITs over the last 25 years is just under 17%.
Wow.
Through 2019.
Wow. So
it's done really well. And then there's two other things that really stood out to me is, and right now is probably good timing to talk about what happened in the recession. So at that time, I went back and looked at 2007, 8, 9, and storage lost less than 4% of its value. Apartments was, they lost close to 7. Retail, office in the double. Yeah. Obviously, the S&P 500 got crushed. So, I see an asset class with a really strong historical rate and then some recession resilience. And then lastly, and this was probably most interesting to me was, there's a consolidation play in self-storage.
Yes.
How there used to be in multifamily. Right? I mean, 10 years ago in multifamily, maybe a little bit longer now, but you could still find a fair amount of mom and pop operators.
Yes, correct.
Complexes. Now that's pretty challenging. There's a lot of institutional capital in the space, and that's happening in self-storage too, right? It's a niche.
Yes, it's everywhere. Mobile home park now as well, right? It's going.
Capital finds yield, Alvish.
Yeah,
right? Capital will always find the yield. So those were the three reasons. The historical, the recession resilience, and then the opportunity for consolidation. That's really why I started pursuing it.
Got it. So you mentioned NAREIT, and can anyone look at that data? Is that publicly available, or does someone need to sign up?
Nope, it is.
Okay.
It's all publicly available, and basically there's an Excel document that you can download. And
oh wow, it's even Excel.
Subsectors. So. Yep, it's a pretty good data set.
And it only covers public REITs, or is it private REIT as well?
That's a good question. My assumption is public.
Public, yeah.
I know that to be a fact. I know with the self-storage, it's the public REITs.
Okay.
But I'm not sure if maybe they have a non-traded private REIT section in there as well.
Got it. So how is self-storage different from residential and commercial rentals, like single family to multifamily? That's how you and I started. And, I'm moving into the space as well. And of course, you have been doing it for 5 years or so. So what are some of the differences?
Well, I think there's a lot. I mean, at a macro scale, Alvish, I would say, think of it like an operational business that's wrapped with a real estate play, at least for what we're doing in self-storage. And, we have 50 across 8 states. We're the 25th largest storage operator in the U.S. So we're a pretty big scale, but in the scheme of things, we're still relatively small.
Right.
But the leases are 30 days. So there's a lot of churn and support to ensure that you're churning customers appropriately. So we have a pretty large marketing function in our business, right?
Okay.
Where, residential, you have you have to be available on the internet, right? But
right.
You get somebody in a lease, you got them for 12 months,
Right. Oh yeah. Most of the time. Yeah.
Pretty consistent. Yeah. Unless you screen poorly. So, that's a big part of it is there's a really strong operational business that supports the real estate play. And there's still real estate too, right? We're still trying to grow NOI. We're still trying to create value that way. We have value add plays, development. But I would say the biggest difference is that just that little tweak around, a lot of people are like, hey, I want to get into self-storage. There's no maintenance. Well, that's true. We're not in fixing toilets. It's a garage on a cement pad. But there's a lot of other things that surround the business that create work.
Right.
Some guys and gals who've done kiosks, all tech, and there's no people on site, and they have a call center that manages it. But the model that Reliant works with, we typically have one or two, sometimes more people on site.
Oh, really? Okay. Yeah, because when I was looking into it, I was all thinking about making it high tech, the remote locking, Wi-Fi monitored cameras, all that. So Reliant relies on having people on site.
Yeah, and there's a play for that, Albert. There's a big called Red Dot Storage that has built a model around, a kiosk-based self-storage facility. And they're in markets where it works well. Another thing to consider is, for us, it's not just about rental revenue. We do things like UHaul truck rental, insurance programs, and retail sales. Sometimes 10 to 15% of the pro forma's income can come from those things. They can be value add items, but if you have a kiosk, it's much, or a technology based, no people, it's much more challenging. You do like U-Haul rental. Yeah. It's much more challenging to upsell people if there's no salesperson behind the desk.
Right. Yeah. So yeah, if you don't have anyone, then definitely your play is only self-storage pretty much. Right. And I'm glad that you brought up the upselling part. You mentioned U-Haul, right? How does that work, and what are some of the other things you can upsell?
Yeah, so U-Haul, I would assume most of your listeners know who it is. They're also the sixth largest self-storage operator in the U.S. They have a substantial.
Really?
Sure. Yeah.
Wow.
But they obviously do truck rentals all over the country, and what U-Haul, how the program works with us is they obviously own the trucks. We are one of the largest U-Haul dealers in the country, I believe, other than U-Haul themselves, because we have U-Haul at every one of our facilities.
Nice.
And so we earn a commission on the rental rates for the U-Haul. And it's a nice coexistence as well, because, you think about it, Alpesh, most people who are renting a U-Haul truck are moving, and there's a pretty good bet that if they're moving, they probably need self-storage.
Right.
So, it's a nice relationship where it works both ways. And we try to enact U-Haul programs at every one of our sites.
Got it. So do you have to have certain number of trucks on site? Do you have to have storage for those trucks, etc.?
Yeah, it depends on the market, right? In the municipality, sometimes the zoning laws are prohibitive on, how much equipment you can have on site. And then U-Haul kind of allocates equipment to different centers because they have lots of dealers and they have their own keep applied as well. So it's always a balance, and it's really market specific. It's something you'd want to review with your municipality if you were looking at a site.
Got it. And so what are some of the other things you can sell if you have, people on site? I have heard about also, and that may not need people, but even cell tower, right? Cell phone tower as well, rental. That's another business model.
Yeah, we only have a couple of those because it obviously depends where your site is and is there a gap in coverage.
Right.
At this point, we actually looked at this a little bit earlier in 2020, and we didn't have any of our 50 that one of the groups was interested in. So that is an option. Billboard, if you have roof space, there's some solar panels with some net metering options. We haven't found that to make economic sense. The bigger things from a tenant perspective, think like a tenant insurance program. So, Alpesh, if you come to one of our facilities and rent a unit, lease requires you to have tenant insurance, or, you have to show us a deck page from your homeowner's policy or renter's policy that insures your goods in the unit. We insure the building and what happens to the building.
Yes, not the inside.
Yep, that's the tenant. So same thing there. We partner with a group and we earn commission off those insurance premiums. Point of sale items, locks, boxes, tape, blankets, all of that's part of the office. And so, all of those things are challenging to do if it's a kiosk type model.
Yes.
Talking through a call center.
Got it. So now let's talk about COVID, right? How self-storage has performed during COVID-19. You mentioned about 2009, which we have seen that it was resilient. But what have you seen during this situation? Have you had any issues with, your tenants and whatsoever, or the renters? I shouldn't call them tenants.
Well, yeah. So, I mean, look, it's October 2nd today.
Yes.
So far, so good industry-wise. And I'll speak sort of at two levels, Albish. As I mentioned, we're relatively small in the scheme of self-storage, right? There's 5 REITs. Public Storage, just to give you a sense, has, I think, at this point, over 2,300 properties across the globe. So how we look at data is we look at our own data, and then we try to compare that to what's happening at the REIT level, because typically the REITs are going to give you a better sense of what's happening across multiple markets, right? We're focused on the Southeast. And so on our side of things, if you think of COVID and how it's affected other asset classes, first thing is paying rent. Our delinquency rate is actually less than 1% through the end of September.
Wow.
Fantastic. And interestingly, if you look at that compared to January's data, we're actually lower now. So more people pay rent now than they were in January. I think that's, purely coincidental. I don't think there's anything in COVID that's making people pay more. But typically in the industry, bad debt is a pretty small number in our underwriting. Because remember, we can sell your stuff. So if you don't rent, that's what Storage Wars, the TV show, is about. They're auctioning off those units.
Yes, that's the part I like. You can just auction off in 30 days, right? You can put a lot
interesting. Like your unit your rent is collateralized by their stuff.
Yeah.
If they don't have any stuff in the unit, when you auction it, there's no money to be made. But anyways, so I would say delinquency, we've very well during COVID. The volume at which self-storage has been rented has been very good. Specifically, July, August, September have been really strong months for us. Things definitely slowed in obviously March, April, and a little bit, and May started to pick back up, May and June. So, what we're seeing is we were, knock on wood, relatively unscathed. Certainly compared to some other asset classes like hospitality or retail.
Oh, yes.
They're getting crushed. So knock on wood, what we've seen has also been what the REITs have reported as well. There's been some downward pressure on rates, rental rates, but that's sort of a short-term hit. Remember that 30-day window on a lease, you can change rental rates pretty quickly there. So
wow.
We've done really well as an asset class through COVID thus far.
Got it. And what are the typical rental rates in the Southeast market? I know, of course, it varies by the market, but, do you prefer the, climate controlled over non-climate controlled units?
Yeah. And I hate to give you the answer of it depends, but it's really
right.
If we have a unit in South Florida, right, most of that stuff's going to be climate.
Right.
If we're in North Carolina, there's a mix between drive up and non-climate. So, we try to balance the unit based on what we think we're going to have to one, what the market demands, and then also if we're going to sell it to the REITs on the back end, typically they're going to want a certain ratio between climate and non as well. So, we're always balancing that if we're looking to expand on, how we expand, do we expand in climate or non, and then make that decision based on what the data is showing us.
Awesome. So let's talk about your deals. Can you talk about your numbers from your best deal so far?
Sure. Yeah, I'd say sold 36 properties, so there's a fair amount of them. Probably a ground up development is one of the best that we've had, certainly from an investor standpoint as well. It was a deal in Naples, Florida. Let's see, we sold it in 2018, I believe. So it was an interesting piece of land that came to us through a JV opportunity. So the gentleman who partnered with us owned the land.
Oh, okay.
Brought the land to the table as his equity, and then we did the development and operation of the facility. And so ostensibly what happened was, because of where it was positioned, there was a really high barrier to entry. So we opened the facility and sold it. We built it and opened it and sold it all within about 18 months.
Wow.
Pretty
So
incredible.
You didn't have to stabilize it, right? Wait for, full occupancy. Wow, that's great.
Yeah, we essentially got what we had projected our stabilized value to be in year 6 in basically month 5.
That's amazing.
So it was an unsolicited offer from one of the REITs because they wanted to be in that market.
Right.
And, so we sold it, and investors basically tripled their money in under 2 years. So that was a good one. And look, that's not how they all work.
Right. I was going to say that past performance are not indicative of future performance.
Yeah, for sure. That was sort of a perfect storm.
Wow. Yeah, because usually I don't like development because I have to wait so long to even before I can get some kind of distribution, right? It's developments are great from, money, because you would double or triple your money in 3-5 years, but till that time you're not going to get any cash flow. But something like this where you can get out in 18 months, that's amazing.
Yeah, it certainly wasn't how we drew it up.
Right. What was your worst deal, and what did you learn from it?
So again, knock on wood, we've had a pretty good run. We've never lost investor principal. We've never lost a property to the bank, right?
That's great.
Yeah, I mean, worst case scenario. And it's not to say that we never will, but knock on wood, we're doing pretty well with that thus far. I would say, it's interesting. The biggest risk for us in self-storage, Alpesh, is new supply coming to market.
Yes.
There's been a substantial, that data that I referenced about how well self-storage is done. Well, I'm certainly not the only person who saw that, right? So there's been a substantial amount of new development in the space over the last, call it 5 years. And so markets that have been impacted with new supply have really struggled, right? Because it's hard to, push rental rates, drive occupancy if there's a brand new facility across the street that's trying to go from 0 to full, right? So, I would say that we've had a couple markets that have been impacted pretty substantially by new supply. I will tell you that I will tell you what ultimately happens in probably a year or two. Our belief is once a market stabilizes, right, everybody fills up, everybody's on the same playing field, and everybody's okay from there. The challenge is when you have multiple facilities in lease-up mode. That's where, rental rates just fall through the floor.
Right, because everyone is competing, right?
You got it. So, I would say that we've had a couple markets that have been impacted with new supply, and I can't give you the specific numbers yet, but ostensibly what happens, right, is your projected returns are based off an NOI, and your NOI is based off rental revenues, right? And if revenues are down, your NOI and distributions go away as well. So we'll see what happens. I think, the most challenging part of our job is, especially in an asset class that's attractive right now, we can understand what the development pipeline is today, but if we're buying a facility and saying to our investors, hang on for it's a 6-year hold or 5-year hold, well, there's nothing to stop people 3 years from now saying, hey, I'm going to go develop a storage facility.
Right.
And it happens to be across the street, right? And we can't account for that. It just happens, and then you deal with it. So that's really the biggest risk when investors ask us, hey, what's the risk? That's it, right? Is when those things happen, our projections go out the window.
Got it. Okay, no, that makes sense. So let's take a quick break, Kriss, and after the break, we'll go through fire round.
Sounds good.
3. Welcome back to Wealth Matters Podcast. Kriss, are you ready for fire round?
I'm ready. Let's do it.
Okay, let's go. Would you be changing any business or investment strategy after coronavirus?
Are we talking about personally or in self-storage?
In self-storage.
Yeah, so I would say that our thesis really, Alpesh, is around tertiary markets. We think there's a consolidation play to be had in the tertiary spaces. And certainly when I talked about the basically glut of new development, it hasn't been in those tertiary markets, right? So if you think of a primary market, kind of like a New York, LA,
San Francisco,
Atlanta, San Francisco, secondary markets, suburbs around those, and then tertiary markets, everything else.
Yep.
I think really that's where we see the yield in the coming years, and pulling together a portfolio that we could potentially sell or exit to institutional capital at some point in the future.
Got it. Favorite real estate or finance or any other related book?
Or any other related book?
Yeah, you can talk about personal development, any, book which can, apply.
So I like, have you ever read The Alchemist?
No. Oh yeah, Alchemist. Oh yes, I did about 3-4 years ago. Great book.
Yeah, that's a good one my wife gave me. I've read that a few times. For people who are, in that transition period of their life, maybe they're in a corporate job looking to do something else, and it's a really good analogy to what many of us face. And I would say a great story, and it's timeless. I think it was originally written in the 60s, and it's had.
Oh yeah, it's a pretty old book, but it's amazing. Yeah.
Yeah, that's a good one. I think that kind of translates to a lot of different things.
Oh, thank you. Any tool or website you recommend or you can't live without?
Oh, for me personally?
Yeah.
So yeah, I'm embarrassed to probably say what the one I spend the most time on. Just silly news and funny things. But I would say just from a work resource standpoint, there's a number of things that I look at on a weekly basis, and usually I'm on an email subscription list that pushes it out to us. I would say for people looking to learn more about self-storage, there's a self-storage almanac that comes each year, and it's a pretty robust document, and it's been published for the last 20 plus years. So there's a lot of good information in there as far as understanding demand, supply and demand, what's happening in the market with rates. And it's never perfect. But if you're trying to learn more about how self-storage works, I'd start with that self-storage almanac for sure.
Awesome. Thank you for sharing. Any advice for beginner investors?
Yeah, lots. I got another podcast, Alvish.
Right.
I'll take this sort of macroeconomic level or macro scale versus specific to storage. But I think, Alvish, the hardest thing for new investors is jumping in and making that first initial investment. It's super easy to do analysis paralysis, right?
Yes.
There's so many paths you can go down in real estate. There's so many asset class, so much information. I mean, you can spend literally weeks and weeks on pockets and just look at people.
I agree.
What's happening. And I would say you have to educate yourself for sure. But a big part of it is just jumping in, right? You have to jump in, do that first deal and see what happens, right? And I'm not advocating do it ignorantly, but certainly, put yourself in a position where you're going to be able to learn the most, and how you're going to do that is to be involved. So for new investors, that's kind of what I always say is educate to a point, and then you got to do it.
Yeah, you got to pull the trigger.
Agreed.
How do you give back?
Yeah, so I try to coach as much as I can with kids and sports. That's been a big part of, as much as my kids probably hate me being involved. You could give back people. I know it was a big deal for me growing up and, having the opportunity to influence those kids. So that's where I spend most of my time now. That's
awesome. How can my listeners reach out to you?
Yeah, for sure. I would say there's two primary points. ReliantInvestments.com is our website. That's a good place to start. You can certainly get in contact with us there. I'm on LinkedIn fairly frequently, and we post stuff there. It's Kris Benson. Kriss is spelled with a K, so it's K-R-I-S. But I think that's probably a good place to go and connect and certainly see what we're working on.
That's awesome. Thank you so much, my friend.
Yeah, my pleasure. Appreciate you having me.
Yeah, absolutely. Have a great weekend.
Thanks. You do the same, Alvish.